At the time of this specific analysis on Wednesday, November 26, 2025, Plug Power, ticker symbol PLUG, is actively trading at approximately $1.95 per share. The market is currently open, and we are seeing a slight intraday downward drift of about 0.14%, with the stock oscillating in a tight range between $1.91 and $1.99. This sub-$2 level is a psychological battleground that tells a much deeper story than just a red or green percentage on your screen. If you are watching this on your Fidelity mobile app or checking your Robinhood investments, the number you see represents a company in the middle of a massive existential pivot that most headlines are glossing over. The expectation for Plug Power has long been that federal support, specifically the massive $1.66 billion loan guarantee from the Department of Energy, would be the lifeline that bridged the gap between their cash burn and their eventual profitability. That was the narrative. Investors held on to shares, believing that Uncle Sam was effectively backstopping the operation. The reality, however, has just shifted violently. Plug Power has recently suspended activities related to that very DOE loan. This is the twist that catches the average investor off guard. You might expect a company struggling with cash to cling desperately to a government lifeline, but Plug is doing the opposite. They are walking away. Why? Because the reality of regulatory compliance, the changing political landscape with a new administration, and the sheer cost of meeting those federal milestones became a burden rather than a blessing. They are choosing to reallocate capital to higher return opportunities and pivot away from projects that require that federal stamp of approval. This forces us to completely rethink the investment thesis. It is no longer a government-subsidized play, it is now a raw, sink-or-swim commercial turnaround story. When you look at the recent price action, you see a stock that has been hammered, down over 90% from its highs, yet the trading volume remains incredibly high. Over 87 million shares are changing hands, which signals that while many are exiting, a significant number of speculative buyers are stepping in at these lows. It reminds one of the volatility we used to see in Tesla stock during its most precarious production hell days, or even the early choppy movements of Nvidia stock before it found its footing in AI. But unlike those giants, Plug is fighting for liquidity. The recent announcement of a $375 million convertible senior notes offering due in 2033 is a perfect example of the financial gymnastics they are performing. On the surface, issuing more debt sounds negative. However, if you look closer, they are using this cash to pay off older, far more toxic debt that carried a punishing 15% interest rate. This is financial triage. They are swapping a credit card with a 15% rate with a mortgage with a 6.75% rate. It is a smart move for survival, but it comes with a cost: potential dilution. The conversion price is around $3, meaning if the stock recovers, current shareholders get diluted. If it doesn't recover, the debt burden remains. Let's discuss the actual business performance because it often gets lost in the noise of debt offerings. In their recent Q3 2025 earnings, Plug reported revenue of $177 million. The expectation from Wall Street was higher, around $187 million. They missed the top line. However, the operational efficiency was surprisingly better than feared. They posted an earnings per share loss of 12 cents, which was actually a beat compared to the forecasted loss of 13 cents. This suggests that while sales are struggling to ramp up as fast as the bulls want, the company's getting leaner. They are burning less cash to keep the lights on. The star of the show was their electrolyzer business, the Gen Eco division. Revenue there popped 46% quarter over quarter. This is crucial because it validates the core technology. Companies are buying Plug's hardware to make their own hydrogen. If you're holding shares in a Schwab Intelligent portfolio or managing your own individual brokerage account, this is the metric you need to watch. Selling hydrogen fuel is low margin and messy. Selling the machines that make the hydrogen is where the scalability lies. The broader context here involves the global hydrogen sector, which is currently in a trough of disillusionment. Late 2025 has not been the breakout year many anticipated. The International Energy Agency recently noted that low-emissions hydrogen uptake is lagging behind policy targets. High interest rates have made capital-intensive projects difficult to finance. This is why you see Plug Power pulling back from building massive plants in places like Young County and instead focusing on equipment sales. It is a defensive maneuver. They are effectively shrinking their immediate ambitions to save the company. If you compare this to the trajectory of other retail favorites, like those you might trade on SoFi Invest or Interactive Brokers, Plug is currently in that dangerous show-me phase, where promises no longer move the stock price, only cash flow does. Before we analyze the looming shareholder vote, I want to hear from you. Comment below with your average buy-in price for Plug Power. Are you holding bags from the $20 range, or are you a new buyer getting in under $2? I am genuinely curious to see where the sentiment lies among retail holders. Now, let's address the elephant in the room, the upcoming special meeting of stockholders in January 2026. Management is asking for approval to double the number of authorized shares from 1.5 billion to 3 billion. This is a staggering request. When a company asks to double its share count, it is effectively asking for permission to dilute your ownership by half if they need to raise more money. The expectation is that this is just housekeeping. The reality is that this is their war chest. They need the option to print shares to pay bills if the revenue turnaround takes longer than expected. It is a safety net for them, but a major risk for you. If you own stock through a Fidelity brokerage account or hold fractional shares on Robinhood, this vote directly impacts the value of your holding. It signals that management sees a future where they might need to sell a lot more stock to survive. However, it is not all doom and gloom. We need to look at the leadership transition. Jose Luis Crespo is set to take over as CEO in March 2026. A change at the top can often be a catalyst for a stock like this. The current CEO, Andy Marsh, has been the visionary who built the hype, but investors are fatigued. Crespo represents a potential shift towards execution and operational discipline. The market loves a good turnaround story with a new face at the helm. If Crespo can come in, slash the cash burn further, and focus entirely on the high-margin electrolyzer sales while ditching the capital-heavy plant builds, Plug could look like a very different company by next summer. This is the contrarian take. Everyone is focused on the debt and the dilution, but the operational pivot might actually work. We also have to consider the technical analysis of the stock chart. Trading around $1.95, Plug is sitting at multi-year lows. The RSI, the Relative Strength Index, on the daily chart often dips into oversold territory, which usually precipitates a short-term bounce. Traders who use Interactive Brokers platforms to short the stock are finding less meat on the bone at these levels. The risk-reward for short sellers becomes unfavorable when a stock is this beaten down, because a single piece of good news, like a new major customer or a favorable interest rate cut, could cause a massive short squeeze. We saw a glimpse of this when the stock popped 11% after hours recently, only to fade. That volatility is characteristic of a stock searching for a bottom. It is also worth noting the institutional activity. While retail investors on investing sides are often emotional, institutions are cold and calculated. Recent data shows that institutional ownership has remained relatively stable despite the price drop. Big funds are not dumping en masse, they are holding. This suggests that the smart money sees the current valuation as reflective of the risks and perhaps believes the bankruptcy risk is priced in. They are likely waiting to see if the 2033 convertible notes buy the company enough runway to get to that EBITDA positive target in late 2026. Let's expand on the expectation versus reality of the green energy transition. The expectation was that by 2025, we would be in a hydrogen boom, with subsidies flowing freely. The reality is that the grid is constrained and electricity prices are high. Making green hydrogen requires massive amounts of electricity. If electricity is expensive, the hydrogen is expensive, and customers stick to natural gas. Plug Power is caught in this macroeconomic vice grip. Their pivot to selling electrolyzers to customers who have their own cheap power, like huge solar farms in the Middle East or Europe, is the only logical path forward. This is why you see the news of their 46% growth in that segment the most critical data point in their entire earnings report. It proves that while the U.S. market is stalling due to grid issues and policy suspension, the global market for their tech is alive. When you look at competitors, the landscape is equally brutal but clarifying. Fuel Cell Energy and Bloom Energy have faced their own struggles, but they operate with different technologies. Bloom, for instance, focuses more on solid oxide fuel cells for stationary power, heavily tied to